What's up, Facebook? Ty Crandall with Credit Suite here, and today we are talking about venture capital. We're actually going to talk a little bit about angel investing as well. So my goal here today is to introduce you to both angel investing and venture capital, teach you what venture capital is. It's might be backwards here, but venture capital unveiled. So we're going to pull back the curtains, unveil what you need to know about venture capital. We're going to talk a little bit about pitch decks as well. So my goal here is that you understand by the end of this training what venture capital is, how it works, how to talk to venture capitalists, how you can get started with getting venture capital if you're a business, the difference between angel investing and venture capital, pitch decks, everything else you need to know to explore this option. So let's dive in. So today we are talking about unveiling and pulling back the curtain here on venture capital. For those coming in and giving me the likes and loves, I really appreciate it. It lets me know I'm on the right track. So let's talk about what is VC. You're going to see it abbreviated oftentimes as VC for venture capital. Well, ultimately what we're talking about here is we're giving money to help new startups and businesses, but a lot of this money is coming from private investors. So look, there's a couple different ways you can get money to grow a business. You can get it from institutions. An institution could be a bank. It could be an alternative lender. It's some kind of organization or lending institution giving you actual money. The other way you can get money for your business is through private investors, people that privately invest in businesses. Now, there's several ways to do this. We've talked before about peer-to-peer lending. Peer-to-peer lending is where average people, just like you and I, can invest as little as sometimes $25 or $500 into an actual platform like Prosper or Lending Club. They pool money together from a bunch of investors, and then they lend that money out to people like you and I. So it's private investors with small amounts of money that were actually investing into other privately owned businesses, and it's a great way to get money. You could work with peer-to-peer lending. It's kind of like the stock market where people invest in publicly owned companies, but people are investing in privately owned companies just like yours and I's. You and yours and I's. That sounds good. So that being said, there's a couple things you can look at. There's one, you can look at investing in companies like this. Peer-to-peer lending is a great way to invest in other companies, but it's also a great way to get investment into your own company. Now, you also have angel investing. Angel investing is when we talk about angels that are investing more in the startup phases of business. Very similar to venture capital, but they are actually using smaller amounts of money that they're actually giving you. Okay, they actually are getting in earlier on in the stages of your business, and venture capitalists is the third aspect, and venture capitalists come with way higher amounts of money. I mean, $500,000, $1 million. I talk to venture capitalists that say our starting point is $10 million. We won't even give you $10 million. We won't even give you any money under $10 million. And venture capitalists invest larger amounts of money. They want a larger stake in the business, a larger equity amount in the business, and they also get involved a little bit further in the process. Now, Susan says peer-to-peer. What is this? Peer-to-peer lending is the first one I mentioned, and peer-to-peer lending are platforms like Lending Club, Prosper, for example. Funding Circle is another one. Okay, what they will do is they will actually pool together money from individual private investors into one amount that's larger that they actually loan out to people like you and I. So for example, if I go to Lending Club, I can apply for a $50,000 loan for Lending Club. Lending Club goes to all their private investor network, pulls together maybe $5,000 from 10 people, then they give me the $50,000. That's what peer-to-peer lending is. So when we talk about venture capitalists, we're talking about getting money to help businesses, okay? And what happens here is that basically they're looking for high growth and high risk, the opposite of banks. Banks would never want to do this. Banks would never want high-risk industries. They want low-risk industries. But what these guys are looking for is very high growth, and they want very high risk. So they understand that the risk of these businesses to fail is significant because they are going into areas that few have gone. They are the leading ones in their industry. There's a lot of things that can happen where they may not succeed at all and may completely fail. But if they succeed, it could be a massive home run. It could be what is referred to as a unicorn. It could be an Uber. It could be an Airbnb. Okay, it could be a Yeti. Okay, it could be any of those kind of companies that have taken off and now accomplished maybe billion-dollar plus level in sales. So banks have to be very conservative with their risk because they're government insured. So the government requires they be very conservative with their risk. It's why it's so hard to get money from banks. But these venture capitalists are the exact opposite. They want really high risk endeavors that have the chance of really high payouts. So that's one of the key differences between banks and lending institutions. Now, they're often looking for very fast growth companies or the potential to have fast growth with an exit in about 3 to 5 years. So what they're looking for is companies that are growing fast and they have a strategy in place to potentially exit, go public, sell within 3 to 5 years. So there's a lot of things here. When you sell a business or you exit a business, how are you going to exit? You could sell the business. You could be acquired by another company. You could go IPO or public offering, right? Those are the three main ways that we sell businesses. There are others, right? We can have a family member take it over, etc. But the three main ways that we exit a business is that we sell it, it gets acquired by another company, or we then have the third option of we actually go public with the option. Or we actually go public with the company. So those are the three main ways to exit. Well, venture capitalists want to see you have a strategy in place to exit in about 3 to 5 years. Now, there's a catch here. They want to own a large piece of your business. They want to sometimes have a controlling stake, which means more than 50%. So we understand venture capitalists because we've all seen Shark Tank. We understand how it works. Okay, Shark Tank's a perfect example of what venture capital really looks like. Not in the real world, okay, but it gives you an idea of the questions and what they want to see. They're looking for companies that have sales already. They're looking for companies that have proven concepts. They're looking for companies that if they could take their expertise and add some stuff to it, the company can absolutely explode, that it's already proven that has significant growth potential, and with what they do, they can make it even bigger. So we see this in Shark Tank all the time. Hey, the sharks will say the value of me is worth more than the money because I'm going to take your little bit of growth and make it massive because I'm going to have my marketing team get involved and my contacts and all these type of things. This is what these guys are looking to do. What they want to do is they want to invest money in your business. They want to have a big equity stake, 10%, 20%, 50, 60%. We've even seen in Shark Tank them take 100% ownership of businesses. They want a controlling factor. Now, that might not mean that they want more than 50%, but what they will want is a seat on your board. They're going to want to create a board of directors, and the board of directors is what I call babysitters. They're the ones that tell all of us crazy startup people that just want to be left alone and do whatever we want to do and not be told what to do. They're the ones that rein us all in and tell us what to do, right? So we see this happen with Uber. Uber's CEO does crazy things. He says crazy things. There's all kinds of sexual harassment in Uber, and then his board says, you're out. So that's the problem with venture capitalists. They want a larger equity stake, so now they own your business. They're somebody you have to account to. They're a shareholder, and they also want to create a board of directors and put somebody from their company on the seat of the board of directors. They may even want to select the board of directors so they make sure their money is wisely used. So you have to be careful, because when you get into venture capital, you're really adopting babysitters. You're adopting somebody from the venture capital. One or more people are going to be on your board, and they're going to be controlling and telling you what to do. But the benefit is that you don't have to pay them monthly like you do a loan. If I go get a loan from a bank or from a private investor, and I get a physical loan, then I have to pay 8%, 10%, 15, 20% interest. I make a payment every single month on that money. With venture capital, I'm not paying any of that back. They get their money when I exit and sell. So the benefit is that I don't have to pay money monthly. They get their money when I exit. But the drawback is now I have a new owner in the company that wants to somewhat control what I'm doing. Now that could go good or that could go bad. And I've heard both. I've heard venture capitalists that come in, take over the company, drive it in the ground, and the people are horrified and they end up selling their equity stake for pennies and get out. And then I've got other friends that own very successful businesses that have really smart strategic investors that have helped them grow the business. That they'll tell you that their businesses have got to 10, 15, 20, $100 million because the investors that invested in them helped guide them to success. So it doesn't have to be a negative that these people sit on your board. It could be because now they're telling you what to do, but it could be a real positive because they're helping you succeed. And a lot of these venture capitalists are very high-level people. So they're going to want to own a larger stake of your base business. And again, they're going to suffer a big loss if the company fails, which is why they want some kind of actual control. Now, who are these people? Well, some of them are partners that you're going to talk to in VC firms. Some are associates where they're just analyzing the models. They're just reaching out to people. Sometimes they're principals. They're owners of the venture capital firm. But in a lot of cases, these associates will be the first ones that start reaching out to you or you connect with. Then if you fit their requirements, they'll move you up to the principal owner of the venture capital or a partner in the actual VC firm. So you want me to tell you how you can get venture capitalists to beat down your door? I'll tell you how you do it. You get on the Inc. 5000 list. You get on a lot of these lists. So for example, Entrepreneur has most entrepreneurial companies in the country. When we got put on that list, venture capitalists started calling us left and right. So a lot of these competitions from Inc., from Forbes, from Entrepreneur, where you could be most entrepreneurial company, or you could be on the Inc. 5000. A lot of those different contests are the way that they actually get to you. When you get on the Inc. 5000, you become the most entrepreneurial company, then what happens is these venture capitalists will beat down your door. Now, a lot of these competitions, if you look at them like best places to work, are very easy. You just have to apply, and if you just apply, you absolutely can be awarded the award. And the reason for that is they sell them. So, for example, we're on the Inc. 5000. Well, they love the Inc. 5000. You know how much money they make? Because for us to even tell people we're on the Inc. 5000 or use that logo, we have to pay a lot of money, even thousands of dollars, to be able to do that. So most entrepreneurial company, best places to work, Inc. 5000. A lot of these are fairly easy to get on if you go through, find them, and apply. And once you do, a lot of them will beat down your door. And the people beating down your door are these associates. There's these associates of these venture capitalist firms that once you talk to and they vet you properly, they'll move you to the principal or the partners in the VC firm. Let's talk about funding stages, because a lot of this you've heard about before, but you might not have seen it mapped out this way. So we start funding stages from private equity with what's called seed money. Okay, it comes seed, it's coming from angels, or it may come from equity crowdfunding. Now, I talked about angel investing a few weeks ago, and I'm not going to spend a bunch of time, but let me explain it this way. Angels get involved very early in your process. So if you're just starting a business, just getting a business off the ground, it's just generating revenue, angel investors will typically be the first ones that come in. Actually, they're going to come in on stage 1, seed, and stage 2, which is called startup or early stage money for marketing, for development. These stages, stage 1, seed money, and stage 2, startup money, these two stages have to do probably before you're even making any money. You have a concept, you have an idea, you're not even generating sales yet. So angel investors usually come in about that point. You're not generating sales yet. You have a concept, you have an idea. Maybe you need 25 grand, maybe you need 50 grand, maybe you need $100,000. You got investors that are maybe max putting in $25,000. Angel investors don't need a seat on your board. They don't need to sit on your board of directors. They don't care to do that. They don't really want a controlling stake of your business. They want a smaller equity percentage. They don't want to control what you're doing. They just like your concept. They like your idea. They want to throw in $25,000 into the ring. You're usually getting that money from affiliated angels, unaffiliated angels, all of which I've talked about before. And if you want to learn more, you can go to youtube.com/credit suite. So affiliated angels, unaffiliated angels, or you're also getting them from these crowdfunding platforms that you can get them from as well to raise capital. Then you have venture capitalists. Now, venture capitalists come in after the seed stage, after the startup stage. They come in what's called a growth stage or a Series A. Okay, this is where you're making early sales. This is where you're manufacturing the actual product that you have. Okay, now this is where these guys will first come in. It's called the first institutional round of money. You've heard these terms before. Now we're tying it all together. So they're coming in once you start selling stuff. It's that simple. Usually the first stage where venture capitalists come in is you had a concept, you had an idea, maybe you got money from private investors and angel investors. Now you've proven that it will sell. People are starting to buy it. Now you're actually starting to make sales. You're starting to make revenue. You're starting to make money. You might not be making profit yet, but you're making money with sales. Now you're manufacturing a product. You're creating it. That is the first stage that venture capitalists come in. This is where you move from angel investors at seed and startup stage to a growth stage, a Series A stage, where venture capitalists come in. Now, then we come in and raise money, and we go to a second round of funding, which is called a Series B. And this is money for early stage business, okay? Selling the product more, developing the marketing solution, not yet profiting. So even in stage A and B, you could have raised tens of millions of dollars here and you're yet not profiting, but that's exactly what they're actually looking to do. So what happens here is angel investors come in. They come in the startup round, they come in the seed round, they give you initial funding. Then venture capitalists come in here and Series A and in Series B, their first institutional round in Series B, and they actually come in and start getting you money. Then you go to expansion. Now you come into what's called mezzanine financing. And this is money where now you're profitable. Now you start to generate. You've used the money from these guys, from angel investors and from venture capitalists in first and second round, and now you're expanding the business. You're getting into what's called mezzanine financing. Okay, and this is when you really start to become profitable financing, or profitable. Okay, and then there's this bridge in between in a lot of cases where startup seeks money in between these rounds. So there's also what's called bridge financing, and this is where maybe you got a big round of funding here in your Series A, you're waiting to raise more money in Series B, but you need some money to bridge the gap between profitability because you're not yet ready, you're not yet profitable. Okay, so you're not ready for Series B, you're not ready for mezzanine, you have bridge financing in between. So that is exactly how venture capital works. Now, here's the questions. Now we understand where startups come in. We understand venture capitalists. We understand the good and the bad. Okay, the fact that we don't have to pay them monthly, but we have to give up equity stake in our business. We understand all that. Here's the next question. Where do we go to actually get money? Okay, and the second question is how do we get it? Well, how we get it is through an actual pitch deck. So you're going to create a pitch deck to pitch to investors. Now, I'm not going to talk about all this today because if you go back to facebook.com/credit suite or youtube.com/credit suite, I have a whole hour training on just how to create the pitch deck. And I'll tell you how good the training is. I used it to create our own pitch deck at Credit Suite. I literally went through my own training, went through step by step and copied exactly what we're doing in each stage. And then what I was able to do was come in and create Credit Suite's pitch deck to go out and raise venture capital as well. So go through that. That maps out everything you need. A pitch deck for venture capital is about 15 slides max. It's not a lot. It has things like your actual demographic research, the problem you solve, the solution to the problem, what makes you unique, what your projections are, what your past numbers are, who the players are, who the people on your company is, who the management team of your company is, for example, what your competition is like. It has all those kind of things. If we think about venture capitalists, they want the potential to make a lot of money really quick. So they want to see if you have competitors, why you're unique, why you're different, why you stand out. They want to see what your numbers are, what you've done so far. They want to see the team that's running the company. Okay, they want to know what your marketing is like, what your advertisement's like. Okay, we've seen Mark Cuban on Shark Tank more than once bow out of a company because all of their business came from Facebook, and that was too volatile for him. He didn't want Facebook. He wants you to come in and say, I advertise on YouTube and Facebook and Google and all these different places to diversify our model. Okay, so again, they want to know where you get customers. They want to know your business model, how much you make on your products, what your margins are. All of that's in your pitch deck. I told you go to facebook.com or creditsuite.com, facebook.com/credit suite or youtube.com/credit suite. And at both of those, you're able to get our training on pitch decks. And again, guys, if any of this makes sense, feel free to give us a ring, 877-600-2487. We can help you with a lot of different ways to get financing. One of the things that venture capitalists look at is how you pay your bills in the past, and it's all based on your business credit history. So if we can help you get money for your business, 877-600-2487. So you're going to need a pitch deck. Second thing, you're going to need to find them. Now, what I found is that, again, I gave you a huge hint. If you go to most entrepreneurial company, if you go to best places to work, if you become an Inc. 5000, almost all of which just has to do with you applying. A lot of those you can get if you're growing, if you just apply. Venture capitalists will come to you. I've talked to at least 2 venture capitalists a week that contact us and want to give us money because they saw us in those places. So if you go to those places, they will come to you. If you don't go to those places, the second place to look is through your angel investor. If you started with angel investors, they are the best source of leading you to venture capitalists, because venture capitalists are smart. If they know that angel investors are investing in companies and those companies succeed and they want to invest in them, then the best place to do so is become pal and buddy with the actual angel investors. So check with angel investors. They're often a good sort of venture capitals, and there's a lot of places online that you can find venture capital as well. All kinds of networking groups, all kinds of actual networks that you can get in front of venture capitalists. But where you go depends on your industry. Venture capitalists try to stick in industries that they know and understand and can provide value in, okay? I'm not going to probably go find somebody in pet supplies, okay? And I have somebody that I've got a lot of advice of raising capital from, but she has taken multiple companies and sold them to PetSmart. That's her industry. So she's never going to invest in Credit Suite because she doesn't even understand her industry. She invests in industries she can actually provide value to. So where you go to get venture capital depends on your industry, because you got to find people that invest in your industry. That's where you got to do a little bit of Google research, because these networks that are set up, these networking groups, these actual sites that have to do with different groupings of venture capitalists have to do with industry-specific venture capital. So where you go depends on the industry you're in. You have to figure out your industry. Then you're going to go online and research venture capitalists in that industry, and you'll find a lot of different places where those guys reside. So again, I'm going to give you our phone number, but hopefully this provides a lot of value today, because we went over a lot of stuff. And remember, if we can help you get money or business credit along the way, give us a ring at 877-600-2487. So remember, angel investors are for startups. Venture capitalists get involved a little bit later. Remember, they're going to want you to have a strategy to exit and sell the business in about 3 to 5 years. They're expecting to take really big risks, and they can suffer a really big loss because they're looking for high growth, high risk companies. Okay, remember that you're going to get seed investment, usually in startup funds, from angel investors. Then you get into Series A and Series B funding from venture capitalists. Eventually get into expansion, or what's called mezzanine funding. And in between these stages, you use bridge capital. So hopefully that provides you a ton of information on obtaining venture capital. We've also talked about how to get together your pitch deck, and the absolute other part that's important, which is where to get venture capital. And we talked a lot about that as well. So if we can help you along the way, getting money for your business or business credit, get in touch with us, 877-600-2487, 877-600-2487. Don't forget, Facebook.com/Credit Suite and YouTube.com/Credit Suite. You can find our training on angel investors and on creating your pitch deck, and both of those will help you tremendously with knowing where to get angel investors to get started with initial capital, and how to put together your pitch deck for both angel investors and venture capital. Thanks, everybody. Have a great day. I'll see you on Tuesday back here on Facebook at 2 o'clock Eastern. Bye, everybody. Have a great day.